Jay Parsons had a LinkedIn piece. We're talking about 10-year treasury yield. We're talking about interest rates, their relations to cap rates. And, this post came on basically, really kind of taking a look at, what's the relationship between cap rates and interest rates. It's a hot topic. It always generates passionate viewpoints on both sides. And basically, long story short, Jay's in the camp of the great Peter Linneman, who has argued that cap rates are not directly correlated with interest rates, but rather with capital flows. And I think it's, it's almost like, I think both things can be true. I think that absolutely capital flows probably have a more important role, but the rates and demanded return, of those capital flows are also, critically important. Because I think that, the point that Matt, that we were trying to make, when we, we made a video, we were basically pointing out that, the previous, like the smallest spread between the 10-year treasury and current cap rates or in cap rates, was basically like 150 basis points, and it's been as wide as 400 some basis points. And we're not saying that one is driving the other. Certainly not cap rates driving the 10-year, and not really even the 10 years driving cap rates. You can watch this video on the Great Capital YouTube channel, but more saying that when the volatility of the rates kind of moves, and when the 10-year the volatility is so great. And when the when the 10-year moves from 0.5% to 5% within like a year and a half, that does have an impact on cap rates and demand for multifamily properties and the market sentiment for acquiring and investing in multifamily assets. You had a comment on the video saying, it's like, well, cap rates aren't a return metric, which is absolutely true. We never said they were a return metric. They are a metric that is a function of income based valuation, which is somewhat relative. It's not irrelevant to return, and we're just looking at, again, what are the extremes. And when things are so out of whack, when we get to such extremes, I think it's important to make note of that fact, because the 10-year treasury, one, relative to capital flows, it's the price of that capital flow for debt. So much of multifamily is financed through fixed rate, long-term debt that's indexed to the 10-year treasury. So it's directly related. That cost of capital, the capital flows are related to that cost of capital. I certainly would believe so. And also, the 10-year treasury relates to, risk in the market and what the risk-free rate is, and alternative investments and returns out for real estate investors. So, that was the kind of the point that we were making in that video of saying, like, look, these things are out of whack. And then I think what rubs people the wrong way is we said, look, if we just took the average relationship, the spread of 10-year treasury and cap rates, that means that cap rates should be somewhere between, basically 6 and 9%. Now, and then we also I don't think cap rates are getting up to 9%, but they're not 5%. They probably shouldn't be 5% either. And maybe, and again, and someone made a really good point. It's like cap rates they're such location and asset driven. We are speaking in broad generalities, which are not accurate in talking about specifics. But in general terms, we're talking about the direction of most of markets in general. Not the markets don't move in lockstep. I mean, Indianapolis, we're seeing rent growth. The rest of the nation is seeing rent declines. But generally, the U.S. market sort of moves, loosely in a similar direction, with some outliers here or there.
Well, and this is something that you've I forget if you mentioned it on the show or shortly beforehand, but it is one of the many, the many factors that determine, a assets returns, or whether, or how an asset is going to perform. It's not a guarantee. Some people may think that it's going to grow, and there's a lot of things that go into cap rates. But my whole thing is that there it's a lagging, and it is maybe it lags a little bit behind the 10-year, unless there's like really sharp movements. Then you're not going to see, it's not going to react as quickly, as just because apartment transactions happen so slowly. And my other point was, that he says that they're not, his argument is he's kind of presenting a counter, the idea that they're directly correlated. Fine, they're not directly correlated, but they are correlated. There is a connection, and the reason why I'm even saying this and trying to kind of like argue my point here is because I know that it is a factor in people's, in people's analysis of a property. There's no way to say that it's not. I'm talking about 10-year rates. I'm sorry. I liked this comment that was citing Joe Pagliari, is that, the technical answer is that cap rates are a function of the cost of debt, the cost of equity, and projected growth. So number one, cost of debt gone up. That means cap rates. That means there's one category in the, the going up section. The cost of equity, I would say, has gone up. It's been maybe, even if that has been, maybe even if it's the same, then number three, projected growth, at least for 2004, we're not going to get there. And again, like there is a force driving it down. It should be driven down, I think, a lot more than is being described here, because otherwise then people are counting on a whole lot of growth, a lot more growth than there has been, to compensate for the wild upswing in the 10-year treasury. Otherwise, like, I don't know how it makes sense. Like, they're really predicting like that much growth.
Yeah, I also, I think where he's quibbling with sensitive versus correlation, and he says, Jay Parsons says that to the point we were just making, so we know the capital flows have obviously been impacted by higher interest rates. The sheer size and speed of the rate hikes ensured that nearly every type of investment, including outside of real estate, will be impacted to a varying degree. So therefore, you could argue that cap rates are sensitive to large swings in interest rates, but correlated is a much stronger and inaccurate description. So I guess, maybe, Matt, we're using just the incorrect term for, correlate, correlated, or we're using it improperly. I think we usually talk about the relationship between cap rates and interest rates, not necessarily that fact that they're, correlated.
And that's another thing too. And just before, it's like there's a clear cause and effect. You can see all these swings and like assign a reason and a motivation why they would drive investors to do one thing or to price their assets lower or higher. And it's frustrating to see it overgeneralized.
Yeah.
If you want to bring up, exactly. Okay, so here's the competing chart. And if you want to explain, you did a great job in the video, and I don't want you to retread any check in the show notes for the link to the really great video that he did. But I'd love for you to explain some of the history and some of these specific drivers, like that made the spread maybe narrow or larger in certain circumstances.
I mean, a long story short, Matt, is, when you're looking at, buying a stabilized asset, the larger spread between, the interest rate on your debt and the income that property is generating, it's already generating, is going to, typically allow you to produce, higher yields, early on your investment, not taking into account your business plan of where you will create further growth. So it doesn't mean that you can't buy on a lower spread or negative leverage of all that, find growth and create some positive, yield on cost. But cap rates are real sentiment, are real, market indicators, and really a function of market sentiment. and kind of the value that the market is, placing on the kind of the value of current cash flows that commercial real estate is producing. And so, we look at this spread, just a couple things. And again, I'm not saying that anything's absolutely, correlated, not to get on the wrong side of Jay Parsons, but just a couple of observations. When these spreads do get narrow, tend to be less than opportune times to acquire real estate assets and multifamily. And when the spreads get wider, you tend to have the opportunity to produce higher returns. Again, we said cap rates aren't a return metric; they're not. But I think there is a relationship.
Yeah.
And just as a quick example, the last time spreads got super narrow were back in 2006, right before the great financial crisis. Not always the best. It's probably not the best time that you could have bought apartments or real estate, because they went through a little bit of a correction in 2007, 2008, and started to recover 2010 or so. Now that spread really widened starting in 2011, 2012. That's been a great time to buy apartments. You saw a lot of rent growth in the next couple of years, and in general, that next bull run in the apartment market, kind of 2010 through call it 2021, saw those really nice spreads. And then in 2022, as interest rates have risen, cap rates, so we're slowly, moderately declining. And that's the big difference here is, we see everything is pretty slow and steady. But in 2022, when interest rates really started rising, that really changed. And, that spread became narrower. And again, we could talk about how, Jay Parsons saying you're going to be on the sidelines for a long time. And I think that's a good point to be made. But the reality is, when as a buyer, if you're underwriting these deals and the equity's not interested in the common equity because the returns aren't high enough, and and your IRRs are, high single digits, low double digits, there's not a large market for that. And so it's just the reality of the prices have to come down and cap rates have to go up. And so I'm really trying to simplify it, but it's because the 10-year treasury is the base financing rate of how we're financing these assets. And these high interest rates is what is making these acquisitions close to impossible. Not near fully impossible. People are still doing deals, but it's very challenging. And a couple things have to happen. Either interest rates come down, the prices come down, or rent growth, or we get a ton of growth. And we're not going to most likely get a lot of growth next year. And so we kind of, if the growing out of it isn't as big of an option, prices have to come down or interest rates have to come down. One of those one of these two things have to happen. And eventually probably both of them will, probably not at the same time. It'll create an incredible buying opportunity again, and these spreads will widen again. So
it's worth
is it I guess so, I think people could say, and people have said, that there are better rates to look at than the 10-year treasury. People, we talked about the triple B corporate bonds. People have suggested tips, all really good stuff. I think it's going to show a pretty similar relation. And I think our only point, and I think we made an extreme point to make a point, Matt. I mean, I don't know. I don't even think it was extreme. I just think we were looking at the math. And the point is, it looks like cap rates are going to continue to rise a little bit. I think that's it.
And it's hard to argue. No, I don't think we are. And you talk about extreme. I think our evidence is extreme because we are at the extreme most narrow.
I mean, I don't want cap rates to go to 9%.
Yeah.
or
And I don't
8%.
and we don't and even in that video, you didn't say there was, because there is a great deal more investor interest, I think, in multifamily than maybe there was in the past. But
Yeah.
the fact is, that the spread has never been as narrow as it has been today. And if the spread was that narrow, you would think that the consensus is that the apartment has nowhere but growth ahead for, it maybe have growth ahead, but as we'll see, maybe, if you read the current rent reports now, there is some rent declines that we have seen currently, and they are projected to have a more stagnant, a more subdued amount of rent growth in 2024. So it's
Yeah.
harder to picture in that growth in 2020. It's not impossible, but like we kind of said, and I alluded to this a couple weeks ago, maybe, when we talked about the low amount of apartment sales
Yeah.
that we had in 2023. It's possible that 33% of former sales, or however, the fraction was, maybe in those sales they projected growth that could exceed it, but the 70% that's missing,
Yeah.
that's not the case. So if you
Exactly.
average it out, then